The psychology of investing. Why smart people make dumb money moves. Why do some of the smartest people on the planet make the dumbest financial decisions? Think about it, doctors, engineers, even financial analysts, people who excel at logic and data, still panic sell stocks during crashes, fall for market hype, or miss out on huge opportunities because of fear. It's not because they lack knowledge, it's because they're human. The truth is, your brain is wired to sabotage your investments. And if you don't understand how your emotions, biases, and instincts influence money decisions, you'll keep losing no matter how smart you are. So, in today's video, we're going deep into the psychology of investing, uncovering why intelligent people make dumb money moves, and how you can rewire your brain to invest like a pro. Hey everyone, welcome back to the channel where we talk about money, mindset, and mastering the financial game. If you've ever asked yourself, why do I make emotional decisions with my money even when I know better? Then make sure to hit that like button, subscribe, and turn on notifications because what you're about to learn could change the way you invest forever. Alright, let's get into it. Number 1, the human brain versus the stock market. Let's start with a hard truth. Your brain was designed to survive, not to invest. For thousands of years, human instincts evolved to protect us from immediate danger, wild animals, starvation, or conflict. But those same instincts like fear, greed, and herd mentality don't work well in modern finance. When the market crashes, your brain screams, "Get out now." When everyone's getting rich from a trend, it whispers, "You're missing out." These emotional reactions come from the amygdala, the brain's fear center. It triggers a fight or flight response perfect for surviving in the jungle, disastrous for long-term investing. So, when smart people panic sell or chase hype, it's not stupidity, it's biology. Number 2, loss aversion. Here's one of the most powerful psychological traps in investing: loss aversion. In simple terms, humans feel the pain of losing money twice as strongly as the pleasure of gaining it. That's why people panic when their portfolio drops 10%, but barely celebrate when it rises 10%. Loss aversion makes us sell too early, avoid risk entirely, or worse, hold on to losing investments, hoping they'll come back. Famous investors like Warren Buffett and Ray Dalio train themselves to overcome this by thinking long-term and detaching emotionally from short-term results. They understand that temporary loss isn't failure, it's volatility. As Buffett says, be fearful when others are greedy and greedy when others are fearful. That's not just financial advice, it's psychological mastery. Number 3, overconfidence. Now, let's talk about another trap, overconfidence. We all love to believe we're smarter than the market. You buy a stock that goes up, and suddenly you think you cracked the code. But here's the thing, even professionals get it wrong. Studies show that over 85% of fund managers underperform the market in the long run. Overconfidence leads to excessive trading, ignoring risk, and chasing trends, classic signs of smart people doing dumb things. It's why even hedge fund managers fall for bubbles like tech stocks in 2000 or crypto in 2021. Confidence is good, but overconfidence blinds you to your own limitations, and in investing, that's deadly. Number 4, the herd mentality. Here's a scary fact. The human brain is socially wired. In ancient times, sticking with the tribe meant survival. In modern markets, it often means disaster. When everyone's buying, your brain tells you it's safe. When everyone's selling, your brain screams danger. This is a herd mentality, and it's why market bubbles and crashes exist. Think about the dot-com bubble, the housing crisis, or the cryptomania. People didn't buy because of logic. They bought because of hype. And when things collapsed, everyone ran for the exits together. As investor Howard Marks says, the biggest investing errors come not from ignorance, but from psychology. Learning to think independently even when the crowd disagrees is the ultimate investing superpower. Number 5, recency bias. Let's move to another mental trap, recency bias. This is when we assume that what's happening now will keep happening forever. If the market's been going up, people believe it'll never fall. If it's crashing, they think it'll never recover. That's why bubbles inflate and why bear markets cause panic. But markets move in cycles, not straight lines. The best investors don't react emotionally to short-term trends. They anticipate cycles. In fact, billionaire investor Charlie Munger once said, "If you're not confused about what's going on, you don't understand it." Meaning, uncertainty is normal. Embrace it. Number 6, the emotional roller coaster. Now, let's visualize what this all looks like. Imagine the emotional cycle of investing. Optimism, you buy in. Excitement, prices rise. Euphoria, this time is different. Anxiety, market dip. Fear, you start worrying. Panic, you sell at the bottom. Depression, I'll never invest again. Hope, the cycle repeats. Sound familiar? The goal isn't to eliminate emotion, that's impossible. The goal is to recognize it and build systems to counteract it. Number 7, how to outsmart your brain. So, how do you stop making emotional decisions with your money? Here are 5 psychological hacks used by top top investors. Automate your investments. Set it and forget it. Automation removes emotion from timing decisions. Have a long-term plan. Decide your goals before the market moves, not during the chaos. Write down your strategy. Seeing it in writing reduces impulsive decisions. Diversify. Spreading risk helps your mind stay calm during volatility. Study history. The more you understand market patterns, the less your emotions will control you. The smartest investors aren't emotionless, they're disciplined. At the end of the day, investing isn't just about charts, data, or analysis. It's about mastering yourself. The market doesn't punish the uninformed, it punishes the undisciplined. So, the next time you feel fear, greed, or FOMO creeping in, remember, it's not the market that beats you, it's your mind. If you found this video valuable, make sure to like, subscribe, and share it with someone who needs a mindset upgrade for their money. And let me know in the comments, what's one psychological trap you've fallen into while investing? Thanks for watching, and